Greetings, and welcome back to the Rose Bros podcast. This episode, we are joined by Martin Pelletier, Senior Portfolio Manager at Wellington-Altus Private Counsel, a multi-billion-dollar portfolio management firm. Martin has over 20 years of investment industry experience, including senior-level positions in both institutional equity research and portfolio management. Prior to co-founding TriVest and its sale to Wellington-Altus in early 2020, Martin's career was focused on institutional equity research and capital markets, primarily at two top-ranked boutique investment banks. Martin is regularly featured in the media as a market strategist, including his weekly column in the Financial Post's Investment Pro section for the past decade. Among his numerous awards, he is a member of Oilweek Magazine's class of 2012 Rising Stars, a Calgary CFA Volunteer of the Year, was given the Avenue Living Award for Canadian Portfolio Discretionary Manager of the Year, and is a Wealth Professional 5-star advisor. Martin holds a Bachelor of Commerce degree with a specialization in finance from the University of Alberta and is a CFA charter holder. Among other things, we sat down and discussed owning versus renting opinions, 10% yields, where interest rates are headed, dividends versus share buybacks, and why Calgary is growing. Enjoy! This podcast episode is sponsored by Conate Water Solutions. Do you need cost-effective water sourcing options to supply your next drilling or completions program? Conate Water Solutions is a specialized hydrogeology company focused on water well drilling, testing, and water management services in Western Canada and Texas. Contact info at conatewater.com or check out conatewater.com for more details. This podcast is sponsored by headracingcanada.com. Looking for high-performance ski gear this winter? In partnership with four-time Olympian Manny Osborne-Parody, headracingcanada.com is offering the lowest prices possible through its online storefront by passing brick-and-mortar savings on to customers. Check out headracingcanada.com for more info and get your high-performance ski gear for the upcoming season. And it's Martin Pelletier?
Yes.
All right. Why don't we begin?
Yeah, let's go.
Thank you very much for doing this.
Thanks for having me.
You were the Senior Portfolio Manager at Wellington-Altus Private Counsel.
Yes, I am.
What is Wellington-Altus Private Counsel for the listener?
It's an investment counseling division of Wellington-Altus. Wellington-Altus is an independent wealth manager here in Canada. Also has a U.S. registered investment advisor as well. And we're the investment counseling division, which is a little bit different than the Wellington-Altus division in itself. We have investment counselors with a fiduciary obligation to our clients, and we manage mostly family office money, and we also run an investment fund.
And before that, if I'm correct, you were a founder/co-founder at TriVest Wealth?
Yeah, and so about 3 years ago, we sold our firm TriVest to become the foundation of the private counsel division of Wellington-Altus. We just needed some significant resources to meet the additional requirements of the pipes and plumbing of the business, which is the compliance and administration, which has changed dramatically over the last 8 to 9 years or so.
From your perspective, would you self-describe as a wealth manager, as an entrepreneur or investor, or how do you view
all of that combined?
All of it together.
And so, I mean, we tend to manage a lot of entrepreneurial type of clients. Maybe that's because we're based here in Alberta, although we do manage assets across the country. The entrepreneurs have a different approach. They've generated a lot of wealth or are in the process of generating wealth through their businesses. And when they come to us, we look at how do we not only protect that wealth, but generate a nice rate of return from a passive income standpoint, given a lot of that risk was taken earlier in their careers.
And originally you started your career in banking, kind of came up through that avenue. And how'd you get into investing in the beginning?
So when I was 14 or 15, I had a passion for investing. I did play this game called Stock Ticker and actually found it online, and my son one of my sons loves playing it. And then I started to getting into investing at that age. I think I was the youngest person at the time to write the Canadian securities course. I was 17. It's a little bit different back then than it is now, I believe. Probably easier back then. Having said that, that's when my passion really got into that side of the business. And then I went to university, did an exchange program, went to some school over in Scandinavia and Sweden, and then came back and started working in the investment business, and more particularly got into the investment banking side as an equity research analyst, specializing in oil and gas.
You're also Financial Post columnist and a big skier.
Yeah, I don't know which is more of a passion of mine. I enjoy writing. I wrote for 8 years when I was on the sell side as a research analyst. And then when I started TriVest, I was talking with the Financial Post, and they got me writing a weekly column for them. And I've been doing it since then. That's 2010. So quite a while. And then on weekends, I'm thinking about my ideas to write about for the next week on the ski hill.
Lake Louise.
Lake Louise is the home base. My kids are on a ski team, Calgary Freeriders, and that's the home base that we ski out of.
Your investment style, would you characterize it as kind of fast money day trader style, long-term value investor, or somewhere in the middle? If you were to summarize your thoughts on investing, how would you write them down?
From an investing standpoint, like I had mentioned earlier, a lot of our clients took risk earlier on in their careers, and they were rewarded for it. And so our main focus is capital preservation. So even though I like to take risk on the ski hill, going off cliffs and doing some tricks, not nearly as much as my kids, but I certainly learned not to try and keep up to them. So I've learned a few things about risk management outside of the business and within the business as well. And there's a lot of risk that's being taken in the investment world. And I noticed that in the energy space, there was excessive risk being taken, especially by certain companies. And that resulted in a lot of lost capital. And so our job is to protect that capital and grow that capital for clients. And so most of our client portfolios are more conservative growth type of portfolios, where we're trying to get a consistent rate of return at, let's say, 6 to 7% and minimize the risk as much as possible to get there.
From your perspective, what is the definition of a value-added portfolio manager? Is it protecting capital? Is it small returns?
I think there's disruption in every industry, positive disruption and innovation that comes out of that. And there's no different in our business. The U.S. registered investment advisor model south of the border has been quite prolific, and it's something they've adopted something called goals-based investing or goals-based benchmarking. I prefer goals-based risk-managed investing. And what that is it's looking at each individual person or client. They have individual needs or goals or objectives they want to achieve with their wealth. It could be multi-generational wealth preservation. It could be using some of the income to supplement their lifestyle or growing an operating business, helping, like I said, helping their kids. But each individual is different. And so the wealth management industry is evolving such that it's not just the investments itself, it's implementing financial planning and then putting the investment portfolio around the financial planning aspects. So our clients, when they come to us, we'll look at their taxes. We'll look at all of their aspects of their wealth, including wills, looking at their corporate structures, finding ways to optimize those parts of their life to achieve their goals and objectives. And so you have to offer more of those services to your clients than just the traditional 60-40 portfolio.
I read an interesting article earlier in the week. They called it the loser's game on how most active managers cannot outperform the market. And after net fees, it's very difficult to provide clients value. Do you think of that when you're advising
Absolutely.
clients?
So the issue about trying to beat the market is that you end up implementing a lot of unnecessary risk. And so what I mean by that is something called career risk. And so as a portfolio manager, if you're not tracking the particular index, S&P 500 or the TSX, and your clients are going to fire you. And so it's okay to track the downside because everybody else is doing it, in order to track the upside. We take a different approach from that altogether. And the reason being is if you're trying to outperform an index or your peers, you're going to do something called performance chasing. And you can be buying managers based on their 3-year recent track record. There's all kinds of evidence showing that when you do that, you end up losing because over the longer term, mean reversion kicks in. If you buy a manager over the last 10 years, for example, they've been the ones that have been the highest performers have been the ones with high duration exposure. What I mean by that is tech stocks or the S&P 500. That may not be the category you want to be in for the next decade. That's why you want to take a step away from all of that and say, okay, what's the rate of return that you want to achieve? Is it achievable in this kind of market environment? And how do you do it and take as low risk as possible? And forget about everybody else. Forget about, the ups and downs of the near-term market environment on the passive side. And then how do you get those returns?
With rising interest rates, have you had to change your perspective on rates of returns, and how has that affected your thinking in investing? If
you look at cash, you can get 5% on cash right now. That's changing things. That changes the dynamics quite a lot. If you look at fixed income on bonds, how much risk is there versus cash at 5%? How do you generate a lot? If your target is 6 to 7%, now your ability to do so is probably better than it has been before because your cash component's yielding 5%. The dynamics of the environment certainly are worth factoring in when you're looking at a portfolio. When you're structuring portfolios, are you balancing it between cash, like you said, it's easy 5%, and equities going for a little more performance? Do you structure it in terms of like a 60-40, or how do you think of it that way? Is it diversified or is it concentrated? Portfolio managers will market themselves based on GARP, growth at a reasonable price, or value, or growth. We don't do any of those things. We look at it in respect to the market. And so what I mean by that is, for example, last year, let's take a look at March of 2020. We had a 15 to 20% weighting in U.S. Treasuries at 20-year, 30-year plus Treasuries. And so we had a client that we had to talk them into, for example, why you wanted to own bonds and long-term U.S. bonds. That took some convincing. But in the end, when March of 2020 happened, the lockdowns happened, that position gained 45%. And that really helped offset the equity component that lost, 30%. So as a result, our client portfolios were down, were protected the downside significantly compared to the broader market. Now, fast forward to a year and a half ago when we had inflation reach out and start to grow and expand while we were being told it was transitory. We had to convince that same client to sell all the bonds. Even though we have discretionary authority, we explain why we're selling bonds, why you don't want to own bonds after we just talked to them and telling them that why you wanted to own them. And that was only a year and a half after that situation. So we took our bonds down significantly at 10%. And replaced that with energy as a component. For example, energy is an excellent inflation hedge. That, in addition to utilizing something called structured notes, which we can get into, resulted in our balance fund only being down 1.8% in a year that was the worst year for a 60-40 portfolio since the 1930s, losing as much as 15%. That's why we're agnostic with our approach and style. We'll look at, and that allows us to be dynamic and adjust it for the market conditions. On the other hand, Nassim Taleb would say, go to cash during high inflation. Why does he say that? Well, I would argue against that because if you look at components like energy, which we didn't always own, we only recently increased our position around the same time we took our bonds down, as I just mentioned. Energy, for example, will gain oil prices will gain 8 to 9% for every 1% gain in inflation. And so having an inflation hedge in your portfolio during an inflationary environment is probably a good thing to have. And so, I was talking about 5% cash, but if inflation is running at 6.5%, you're losing money. And so cash is a good place to be if you think there's going to be a change in a certain segment of the market. So right now, if markets and asset prices do pull back on quantitative tightening, you have that cash and it gives you optionality to do many different things, and you're getting paid okay while you wait it out. Interest rates.
Where do you think they're going? Does it matter to you? Are you agnostic? Are you advocating for higher rates, lower rates? What's your opinion on that?
Interest rates are very, very important. Probably the most important they have been in my investment career. The reason being is we had a decade of ultra low interest rates. At the same time, you had no inflation and low unemployment. So we had the perfect situation that was set up. And so people looking at from a recency bias are saying we're going back to the way that was. They're placing their orders and their trades based on that expectation. And that's why it's very important to look at something called duration exposure or sensitivity to interest rates. And that's just not just bonds. So for example, if you have if you have a 10-year bond with a 10-year duration, a 1% increase in interest rates would mean that that bond will fall by 10%. Very simplistically. And so if you have a 20-year treasury, obviously, and we've had big moves in interest rates, significant moves the last year, managing that duration exposure has been very important on the fixed income side, but it's also been important on equity side. And this is where I find it really, I get confused because when I ask a number of managers what their duration is on the equity side of the portfolio, they kind of give me a blank look because they don't manage it. But there is equity and interest rate sensitivity, and it comes down to the realization of cash flow. So energy companies are really short duration because you're getting a cash flow right now. You get that cash right now. And it's paying a good rate of return now. And so that front end loaded cash flow is very important. Whereas tech companies are promising you a big growth rate and that cash flow is up 10 years or 20 years out. And investors are demanding it to be shortened. And so that's why we're seeing all the layoffs in the tech space is because they're trying to front end load that cash flow and accelerate it instead of having it, some promised date in the future. And so that's why it's important to look at both of those factors.
In your opinion, do interest rates need to go higher?
Yeah. And so where is the direction of interest rates? I think in Canada, we're probably just based on the recent GDP data that we've seen, we're not facing the same kind of inflationary pressures as they are in the US. The US economy is in a stronger position. I've had some really good discussions with individuals that have worked at the Fed, for example, and CIOs at very large global macro funds in the US. And looking at Canada versus the US, Canada has a much greater sensitivity to interest rates. So I would say a greater duration exposure sensitivity. So the reason I'm saying that is, real estate's a big component of our economy. The average terms of mortgages are 3 and 5 years. And so the 5-year government bond. And then if you're looking at the US, they have 30-year term mortgages. And so, if rates go up, your mortgage isn't going to get impacted. Whereas in Canada, it could get impacted a lot. So I think the sensitivity to rates and higher rates in Canada is greater, and it'll have a greater impact on inflation and spending and everything else in the US. So I think we're going to see flat, no rate hikes this year from the Bank of Canada, and maybe another 50 basis points in the US by the Fed.
Do you think we need higher interest rates?
Not really. And I think we need the signal that, just holding where we're at over the next 6 months will have a huge impact because everybody thinks we're going to have rates going back down again. But if they don't go back down again, that'll have a huge impact. As soon as these term mortgages start coming up for maturity and you get a huge spike in your mortgage cost, that just takes money right out of the economy.
The difference is sometimes between what we need and what we want. But in this case, from your perspective, we're actually doing okay. We don't need to cool things down too much.
Well, you do in order to get inflation. You like the services side of things. There's a friend of mine just got back from Hawaii, and he was saying that those acai bowls or the yogurt and fruit bowls, he had 4 of them, and it cost $72 for breakfast for a yogurt bowl. And so we need, and $300 hotel rooms are going for $1,000. And so that needs to stop. There's 2 jobs for every job in the US, every person looking for a job. And so in Canada, it's not quite as strong, but still is strong. So the only way you get inflation down is by impacting the consumer. And interest rates is a great way, and it'll have a greater impact here in Canada. So we just need to slow things down. And that's certain. You saw that in the GDP numbers that came out. We had no growth. And I think that's going to only continue to be the case.
Do you worry that things are growing too quickly in the Calgary area now, that things are back and they're strong again?
Well, I just sold a house and bought a house, so it was a unique experience. And I always like sharing those types of experiences from boots in the ground. And houses are selling at quickly. If they're priced at market, they're selling the same day or the next couple of days. Yeah, at or above the list price. And that's really surprising. And I don't think that's the case in other jurisdictions. I was at an economic development update for breakfast a couple of weeks ago, and I think there was the economist was saying there's 55,000 people that came into Alberta last year, half from other provinces. And so it doesn't take much to move the needle, especially when supply of houses is very low. And so there's a lot of people are adjusting their lifestyles for the higher inflation by moving to places like Alberta, where the cost of living is significantly lower than Toronto or the GTA. And the quality of life is pretty darn good. It's probably one of the best kept secrets, but I'm just a little biased because I like the mountains and skiing.
That's what I said.
Yeah.
Best kept secret.
Well, they're advertising now, and I'm not sure why they want to advertise, but they're advertising so that it's no longer a secret.
Why do you think Calgary's doing so well, other than it's a low price environment? Is it recovery of energy? This is
something that people really miss. There's major inflection points that have happened throughout history in the economy. We saw one in the bursting of the tech bubble in 2000. You had the U.S. subprime crisis that really impacted the banking system in the U.S. in 2008. And then you had the shutdown of the global economy, which has never been done before other than, World War II. And that created a lot of permanent changes in society. And so one of that is work from home. And so on the ski hill, I always talk to people on the chairlift. A lot of people move to Canmore from Ontario, and because they can, and they have the flexibility to work. And now they're living in the mountains and skiing every day and working from home. That would never have been the case pre-COVID. And so that's just one example. But there's a lot of that happening, and that's been very beneficial to Calgary in particular, but even more so with our housing pricing being so low. Our schools are half the cost, and we're a built-in inflation hedge. Reason being is energy. Now we're running a big surplus, and we don't have a provincial sales tax. And our income tax is although it was increased with the NDP, it still is among the lowest in Canada. Throw all of that combined in the mobility of labor, no wonder people want to live here.
Should we be paying down the debt in Alberta?
What do we do with that money? Well, we are. I mean, we're paying it down. There was a lot of debt that was taken out. I think we have to find a way to transform our economy. We're capped on growth on the energy side. That's fine, right? Let's use that flush cash flow. The world is changing, and we have to recognize that. It may not be as quick of a change as what many are expecting with electric vehicles, for example, the electrification and the greening of the economy. It is changing, yes. It may not be at the same pace, so we have some time. But what does that look like? And I think those are the conversations we need to have. I don't have answers, but there are things that we can do. And the first step is just recognizing that we're lucky enough to have that money. Number one. Number two is, how do we use it? Did we pay down debt? That's not a bad thing, especially as rising interest rates and interest rates stay in. But we need to think more than just that.
The political temptation is to buy votes with the money. Your opinion. So how do you balance that between fiscal responsibility? Is it that there's no easy answers, but if you had a few tips for somebody in charge, what might you suggest? Well,
I mean, it's all spectrums of government. I mean, and also all parties. So I'm trying not to be partisan here, but if you look at nationally, you have a federal government that's running a deficit and a large deficit, not just here in the US with Biden administration. You don't want to be running deficits when you have your central banks raising interest rates to slow down the economy, to slow inflation. There was, I forget which state it was, they're thinking of indexing the minimum wage to inflation. You're better off to have wage growth, yes, but inflation less than that wage growth. It's the chicken or the egg, but you have to bring inflation down, and fiscal spending has to be responsible. And that means some near-term pain. And so sometimes you have to call it like it is as a politician. You have to just say, we got to pull up our pants. I mean, this is a tough situation we're in, but we all we're all going to make these changes together to get there. And it's going to be painful in the near term. And you look at what Ralph Klein did in Alberta. It was very painful. And then we came out of it that much stronger. I'm not saying we need to go to that extreme, but certainly let's help our central bankers make their job easier instead of harder. If that costs you votes, then so be it. I mean, sometimes you have to do what's the right, they have to do the right thing. And that may be unpopular, but I haven't yet to see a politician do something like that we all know it's good. Sort of like a parent and you're advising your child who's a teenager is doing something, you just have to give that advice, right? And you have to implement some of these things. That's just the plan. If you don't like it, then, you vote somebody else in, but, it's going to make the situation worse.
Well, that's the problem.
Yeah.
In terms of capital allocation, you understand the workings of energy companies and how things work and the right or wrong ways to spend money. The Berkshire report came out last week with Warren Buffett's comments on stock buybacks. In your opinion, it depends on the company, but do you lean towards buybacks or dividends? How do you think of it that way? Are you in favor of one or the other? Or?
I like dividends better because I can take that cash flow, that money I'm getting back, and I can either, buy more stock if I wanted to myself, or I can buy stock in another company. So it sort of reminded me to my old iBanker days, and I used to get in disagreements with them all the time because they favor doing equity deals on M&A. And I'm like, cash really is king because cash gives you the optionality, to do what you want, what you can do. So yeah, buybacks are good. Timing of buybacks, the record of these companies doing it are not so good. But I like dividends. I like both. I mean, there's nothing wrong with I like what's happening with the energy companies and not putting it back into the ground. Well, just enough to maintain production. People don't want oil, so don't give it to them. Just take the cash flow, give it to me. And if I want to buy more oil, I'll do it through your company. Mm-hmm. If I don't, then I'll go do something else. I'll put it in cash at 5%. I'll look at a whole bunch of different things.
Warren's comment would be that buyback shares make sense if the market price is below intrinsic value, which is tricky. Well, maybe not hard, but that's when you'd make the buyback. Do you think that the buybacks are mismanaged a lot of the time? That's why they get a bad rap, or why aren't they as popular as they should be?
Well, he owns a lot of private companies, and he owns really good private companies, and he has a lot of cash. So he doesn't want that cash back. So, and so reducing the share count and paying down debt, that makes sense. For other investors, getting that cash gives you that optionality, whether you want to put it back into that company or into another company. But for the most part, if you own good companies, good value companies, that's the companies that he owns, of course he's going to be favoring buybacks. But a lot of us may not own those types of companies, or maybe cyclical or other factors, that, for example, if you're letting drift happen and you're going to be owning more and more of an energy sector that you may not want to have, you may want to have some diversification.
A lot of the yields are approaching 10% in the energy sector right now. Does that scare you, or the balance sheet strong?
Balance sheets are the best position I've ever seen them in. I've never seen the sectors there's been no capital available to them for probably since 2015. And so that means they've been very prudent with their balance sheets, and they've been paying down debt and doing buybacks. So they're in fantastic shape. There's been consolidation, so the operating cost efficiencies are that much better. So I've never seen the sector in such good shape as it is now.
a lot of people have been poking fun at certain companies because their yields are so high. But then on the other side, the flip side, you see there's no debt, which I think a lot of people ignore. The fact that a lot of the dividends are sustainable at pretty low prices. Have you had to explain that to you?
Well, cash is at 5, and so is 10 and really that bad? Right? Because if you look at if you look at that, like the market dividend yields versus a 2-year bond, you're not earning above that 2-year bond. Is 10%, when interest rates are at 1% and you're yielding 5, that's pretty good. People say, well, 5 is ridiculous. Well, what's 10? You have a reference point's 5. Right. So I think I'd own that stuff all day long in this kind of environment. And again, going back to your cash is king in an inflation environment. That's I think where the argument comes in.
Having to be right when everyone else is wrong is very hard to do. Prove yourself right. Have you had to do that in certain scenarios with the energy sector investing heavily nowadays? Well, I'm going to read you something I just posted. And it really highlights my thoughts on things. I put this out this morning. Best advice I ever received was to rent my opinions, known my mistakes. This way, one will be okay with asking how they can be wrong. I've noticed many on social media do the opposite and turn their opinions into an identity and watch what happens when someone questions their identity. And so what I mean by that is you have to be as open-minded as much as possible, not internalize a certain belief about something, because when someone questions you about that belief, then your defenses are going to come up. Perfect example in looking at energy is we ran an energy hedge fund back prior to the OPEC attack on shale in 2014. And we shut that down a year after, and it was the best thing we did, because it was following that from 14 all the way through to 2020. Those were the worst 6 years I've ever seen. And when we owned something and it became our belief system that you always want to own energy, that would result in very poor returns for 6 years. When we had a fund, we had to tell people to always be bullish about it. And now that when we shut that down, that allowed us to be open-minded and rent our opinion and ask how we're wrong. And it allowed us to get out of the sector and come back in again, right? And now that we're back in, we're always looking for a reason why we might be wrong. And so we're always looking at the other side, because it isn't my identity. Even though I was an energy research analyst, it's not my identity. And so I can always ask myself, how am I wrong? Maybe there's time to get out of this, right? Instead of defending an opinion. And so far I haven't found anything, or we haven't found anything that would tell us that we're wrong, but we're always looking for it. And we have to also recognize that there is potential disruption. Not yet, and there will be a time, but we have to recognize that there could potentially be that as a threat. And so I lived in an eco community. My house was almost net zero. So, and not one house owner in that entire community had an electric vehicle, but we had net zero houses. And so that told me something. I'm looking at ways to be, having a low carbon footprint is important. It's huge. It's very important for our kids. And so how do we do that as a province? How do we get there? How do we map that out? Forget about this just transition and all of this nonsense. And it's just greenwashing and political. Like, let's just find a way. We're engineers, and we're probably the top engineers in the world. And we should not be getting bridges in downtown Calgary made by steelworkers in Spain when we have the best steelworkers that worked on the Bow Tower. That mentality is what gets us into trouble. And that's not just federally. We have to look. That was at a municipal level that we made a decision like that. So we have to look at these things and say, okay, where's the world? Oil is not my identity. And how do we make these changes? And there's no easy answer. I don't have the answers, but by changing your viewpoint and not having these entrenched belief systems, that's how we're going to adapt. Anti-fragile. Right. Nassim Taleb.
Yeah.
To what extent do you think Canadian energy can be the solution to a cleaner future for Canada and the world?
Well, don't forget, we already are kind of there. I mean, you look at at our energy production in the country. Hydro's huge, and
natural gas, but we have to look at beyond that. We have to. I mean, we have to recognize the situation that there is no pipeline capacity growth. There is no capital. There is no desire to get these resources to Tidewater. It's just not going to happen, right? And what do? Like, we got to start there instead of fighting something and then using the same old Ted Morton arguments that we've seen on energy security. I mean, it's just got to put that to rest. Absolutely. And find ways to adapt and move forward. I mean, we just talk about lifestyle moving to Calgary. We got 35% vacancy rate in downtown Calgary. And downtown Calgary, I mean, I've traveled the world and I could have worked anywhere. And downtown Calgary is, other than, if you don't like winter, but it's still a pretty good place. Yeah. One way I've talked about it with other people on podcasts is framing, for example, Canadian energy in terms of a clean solution. If we were to frame it that way in terms of helping to get off coal and
not going to work.
Certain dirty fuels.
It's not going to work.
Do you think it'd be better?
No, it's not going to work. Like, it's just, you can't even have that argument.
Yeah.
People have, again, their belief system.
Right.
It's become religious for them. And I want to be careful about that. But when you have those kind of entrenched beliefs, you can throw facts all you want. It isn't going to change their mind. You can reframe it all you want. It isn't going to change their mind, right? You have to connect with them at a personal level. And it's in all things, from vaccinations to everything, that when people have their beliefs about it, you have to recognize their beliefs. And it doesn't mean that you share them, but I'm trying to change their mind. It's just not going to work.
Yeah. In terms of economic opportunity lost, is that an angle perhaps that may work to convince people on the desirability of Canadian energy?
Idealism is easy when it costs you nothing and it costs everybody else. And so there has to be a cost. And then that cost. And so it's easy to make that stance when you're wealthy and you can afford to pay this or pay that. And you're saying everybody else should. But when you're working 3 jobs and only thing you can afford is a $4,000 used vehicle, and they're telling you have to go and buy an electric vehicle even if you have to buy a little tiny vehicle, Chevy Volt or whatever, and you've got a family of 4, and like, it just doesn't make sense. So you need to recognize the state of where people are in, and it needs to have a cost. And when you see it like that, that's how you change behavior. All of a sudden now, if you have like clean and you're living in the city and you have awesome transit and it's electrified and it's fueled by maybe natural gas or whatever, and it's readily convenient and accessible and affordable, and you make it so for people, it'll change their behaviors. It changed my behavior. I am the almost net zero house, and it didn't cost me a lot. Probably the cost of my high-end, instead of having high-end countertops in my kitchen, I was able to have solar panels. And it made sense. So that's how you invoke change, is convenience and cost. You can talk all the ideology you want. It comes down to cost and convenience.
Right. In terms of investing, where are you looking nowadays? Do you see opportunity in traditional energy, renewables, tech, banking?
Right now, at this point in time, we're still managing duration exposure. So we have the lowest weighting we've ever had in fixed income, and that's not changing. We are looking for reasons why we could be wrong, and we dipped our toes by extending that duration and then remove the trade. It's not the time. So on our fixed income or on a balanced portfolio, our lowest allowable weight is at 10%. And that's just really low for a balanced portfolio. And that's where we're at. Energy is still 15% of our client portfolios, and that hasn't changed. We have trimmed it back on the rallies and maintaining a nice position. That may not seem like large a large position for those in Alberta. Outside of Alberta, that's significant, especially when the S&P is only, I think it's 5%, whereas the TSX is 17%. So that's why we favor the TSX. We like Canadian banks. Despite the interest rate sensitivity, they've offloaded all of their bad debt. They're in good financial position to the shadow banking market, which is now fully supported by the government. So we like the Canadian banks. We like consumer non-cyclicals. We like industrials from an equity component. And we like the U.S. market, not the S&P, but the Russell 2000 and some of the small cap where there's some value. You were looking at international. We're not there yet. We're at the lowest weight as well. And then finally, structured notes. Structured notes are 30 to 40% of our portfolios, in some cases even higher. And that's been very good trade for us.
Have you seen value in tech?
No, not yet. I mean, you look at, if you bought Intel the last 6 years, you didn't make any money. If you bought Cisco at the peak in 2000, it took you 20 years just to get your money back. Yeah. And Cisco is a great company. Yeah. I own John Chambers, Connected Dots. He's probably one of the smartest entrepreneurs I've ever come across. So you could be an Olympic swimmer in a pool full of sharks. You're just going to get eaten. And so I think that's people keep looking and saying, sort of like when you own a double levered or triple levered ETF and you look at this chart and you're like, wow, it was $100. Now it's $5. Mm-hmm. I'm going to buy it because it's going back to $100. Right. If there's a structural change or a shift, it isn't going back. And yeah, we own some. You know, there's some companies like Apple and Microsoft that generate cash flow. Right? And they're competitive, right? And there isn't a lot of competitive threats. So we own some of that. Yeah. Yeah. But it's not as large as the S&P where you've got 5 stocks at 25% of the earnings.
Sure. Kind of like buying the right asset for the right price.
Yeah. That's old school. I think old school is new school in 2023. Old school is new school. Finally.
Who are your investment influences? Do you have anyone? Warren Buffett, Howard Marks, Charlie Munger?
Those are all good names. I mean, I've been watching Charlie lately, obviously, because it's their annual report and there's nuggets of wisdom coming out of there. But I also look at, I just mentioned John Chambers. Like I also look at the innovators as well too. Elon Musk and maybe that's not the best example, but I mean, he is an innovator. And so I'll look at the old school and some of the new school because the new school will eventually become the old school and we'll get there. You know, you always have to be moving. Movement is life. My grandfather lived to 102. He walked 5 miles a day, and that's why he lived to 102. He drank and smoked, did all the wrong things, and he quit eventually, but he walked. Movement is life. You always have to be asking yourself what's happening, and you just can't settle for the status quo. You settle for the status quo, you're finished.
Mm-hmm. You ever been to the Berkshire meeting?
No, I haven't. It would be really cool though.
Charlie's 100 now, so I figure I got to go soon.
Yeah, it would probably be on my bucket list. Like, so I saw Pavarotti. I saw him before he passed away. That was pretty cool. And Tony Bennett, right? And people were giving him respect. They were walking around when he was singing, and he was 91, and he was unbelievable. I mean, and so yeah, Berkshire meeting. Good point. I got to add that on the list because time's running out quickly.
I think that's a real good snapshot of Martin Pelletier. If we were to leave a listener today with maybe some advice for in this economic environment, what would you leave them with? What would you tell them?
Well, to quote Sinatra, I did it my way. Just do your own thing. Forget about everybody else. Munger said it's not greed that's the biggest risk to people's portfolios. It's envy. And so I've been writing a lot about Zen and inner Zen and been on a contemplative journey. I'm not Buddhist by any means, but I do read everything. And so, do your own thing. Have your own game plan and recognize that I call it preferences instead of goals. And so you have a preference for something. So you go into a restaurant that's famous for tomato soup and they don't have tomato soup and they have chicken soup. Don't get all mad because there's no tomato soup. Just go for the chicken. It's pretty darn good. Come back again for the tomato soup. Same thing with your portfolio. Have a preference for things. Things don't always turn out. that's okay. But be flexible, do your own thing, and stay away from what's everybody else is trying to get you to do. And that philosophy has served me particularly well over the last 3 or 4 years. And always keep moving. Movement is life. COVID, I put on a few extra pounds. The ski season, my son broke his arm, so I haven't been moving as much as I like, and I can feel it. I'm moving again. I'm going out and I'm skiing again. And so always keep moving.
That's awesome. Why don't we leave it there? Thank you.
Perfect.
I appreciate your time.
Thank you very much.
Thanks for listening, everyone. Hopefully you enjoyed the episode. If you liked what you heard, check out rosebros.ca, where we will have upcoming shows. Until next time, happy coffee drinking.